present to you. Today is Thursday, the 12th of March, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. So, this is the trap many boards fall into. They talk about capital when they need capital. By then, the conversation is already expensive. And I'm going to explain this because today's asset lens is the financial assets. And specific asset I want to mention today is the capital stack optionality. And optionality is a key word because you cannot have only one source of capital in terms when you are raising capital or you're looking for a credit line, etc. Now, because the opportunity most board miss is capital conversations is not the deal. What I mean is, it's not about having this conversation with institution, investors, stockholders, etc. Is the timing the biggest issue, right? So I spoke all this week about this. I'm using the same operational model that I'm going to put into the screen right now so you can see it. Because many boards, many executive team, many company owners have this challenge. They see everything straight as a linear business continuum, if you may. So everything's happened today, one thing after the other, one fire after the other, instead of an ecosystem of things that actually happen all at the same time, at the same in the same day, in the same week, in the same month. So this ecosystem fix or report itself when they have constraints, right? So if you have a capital constraint, many things have to be happened and will happen when you have the ecosystem ready, meaning all your strategy, your performances, your governance, risk, and compliance, your assets, your partnerships, your people, your brands. So everything works together. So when you say, I'm going to raise capital, then you are ready to go because everything is aligned, not as I have to do things today in a task manner, but as an ecosystem. So everything works together at the same time in the same place. Now, I'm going to explain this further today, but as an advisory board and supported by the International Advisory Board, I help organizations install missing capabilities faster than a single hire. So this is a mistake many companies do. They hire somebody for a big event, something very complex, and that person, that talent, with all that expertise and all that experience, seems to be sitting idle there for a long period of time and doing tasks that actually are not really the capability of this person, and then they leave and I say, oh, we have an exodus of talent, probably because have been hired for something very specific for a period of time, and then their function itself is not that important, so it starts to fade into the organization. And with a rotating expertise that I can put together with an international advisory board, every 6 months, as the project changes and evolve, you have the pool of talents that you need for the things that you're looking for. That's what I call it, an ecosystem. And this is a graph that you see in there. Now, back to the capital raising. Timing is the opportunity most boards miss in capital conversations, not the deal itself. And let me show you 3 problems. By the way, all these things that I mentioned here are valid for large PLCs, small PLCs, small caps, limited companies, 50 employees, 300 million pounds of revenue, or 50 million pound revenue, or for a company that is an executive team or a owner, founder backed by capital that say, how we're going to go to the next thing. Yesterday, we talked about founders bottlenecks, where the dependency of the founder is a risk for the company. And today we are looking into capital raising. But actually, I want to mention that too, because as you say, if I'm a founder, you also be part of the risk of when you're raising capital. Believe it or not, even if you say, I am the person that put this together, this company, this idea, this revenue, etc., capital sees a founder dependency as a big risk too. But let's go into this option, this portion of the capital stack. And the reason why is because you want to have options when you don't want to be a menu of somebody else. You want to have a menu of options when you're raising capital. And there's three things I'm going to mention in terms of the UK environment, but actually that works in any other country environment because the regulation is pretty much very close to each other. And if it's not, then you have a template that actually works very well and is available in the public domain. Okay, three problems. Number one is the Financial Conduct Authority's new rules under the public offers and admissions to trading regulations came into force in January this year, on the 19th of January 2026. And it says they are designed to make it easier for companies to raise capital in the UK and reduce costs if boards are still operationally unready and they will not fully benefit from a friendlier rule book. What I mean with this is actually you have a rule book now that actually is dictated is a word, it's suggested, or actually you have a framework as the Financial Conduct Authority. Now, why this is a problem and this is useful, because actually if you're not ready, then they are going to look into the Financial Conduct Authority and they say, probably you're not feeling the right things here. So you will be rejected because of there is a compliance requirement there. Second problem is the Bank of England 2025 Q4, actually Q4 last year, credit conditions survey that shows that leaders are still closely monitoring corporate demand and conditions. So what it means is, which is capital is available, but that does not mean boards get attractive terms when they arrive late, meaning preparation, options, right? And we are going to disclose all disclose. I'm going to explain all this in this live stream. And you have a third problem there, which is the interest rates are lower than their recent peak. But the Bank of England still had the bank rate at 3.75% after December 25, last December. They did a cut there, but with inflation above target and spending weak, so the cost of capital discipline still matters. Now, all these technicalities, we are going to park them. I'm going to go into practical things, right? But it's just to give you the scenario. So there is a rule book, there are capital raising challenges and interest rates. Let's put it in other words. Imagine waiting to design your capital stack until cash gets tight. Then it's like shopping for insurance while your house is already burning, right? So who do you think is going to insure you? Probably not many people. So that when you have this challenge of capital that is tight and you are, I wouldn't say in panic mode, but actually you go into the edge of a problem looking for capital, is very hard to get and probably is going to have other challenges that I'm going to mention too, is in terms of your company valuation. So this is why some boards keep getting surprised, if you may. They think that capital conversions or conversations start with a fundraise, but they are not. They start with trust. And here's the key question that you should consider. Can the board explain liquidity? Yeah. Can the board explain facility headroom, right? Can the board explain convenient pressure? Can the board explain working capital behavior? And number 5 is, can the board explain where new capital will go and why now, right? So if you have these questions before even going to raise, then start to clarify what is the perception that is going to happen on the other side, which is you are prepared, you know what you're doing, and you have a very clear destination for that capital raise. So when boards are unclear, the market assumes the worst and lowers the valuation. That is mean a discounted valuation, which means that they value the company lower, meaning that actually they put you in the category of higher risk than lower risk and more leaning to lend to your company or to invest in your company. So as a board advisor, what I would propose to consider is the following 3 things. Number 1, treat capital as part of the strategy. And you see in the graph here, do you have a strategy? So capital is part of your strategy. It's not a treasury admin task. Yeah. So the Financial Reporting Council Strategy Report Guidance frames annual reporting as a communication with shareholders, which means boards need a clear narrative about reassurances, risk, and direction, not a last minute scramble, right? Suggestion number 2, use the regulatory window properly. So the Financial Conduct Authority's reform reduce friction, but only for companies ready to move with a credible story, clean disclosures, and a coherent funding plan, right? So use those windows properly. And suggestion number 3, build optionality before pressure. And this is the beauty of this. Your own source material is right on this point. If you wait until you need capital, you are likely to get a bad deal. The practical translation is simple. Keep the capital stack visible, forecasted, and decision ready, right? So, in other words, as a mentor of mine used to say, the CFOs and CEOs, one of the main reasons or main responsibilities of these two functions in the organizations is to look for money all the time, particularly when you don't need it. And I'm going to give you an example later on. So this is where boards often need outside help. Yeah? Not because management is weak, because capital conversations cut across finance, strategy, governance, market timing, and credibility. So one CFO cannot always solve that alone. One banker cannot solve it for you either. So one consulting deck does not make you fundable. But an international advisory board is useful here because the capability mix change by phase. And I'm going to mention a few phases. So if you have an international advisory board, independent from your management team, from your non-executive directors, etc., what you have is 5 different phases, and you can change the members of the advisory board for the expertise that you need on each phase. So you need a phase for pre-funding and talents for pre-funding. You need a phase for refinancing, and you have talents for refinancing, which are not same talents for pre-funding or pre-fundraising. Then you have acquisitions, then you have turnaround, and then you have international expansion. And all these things have different capabilities, expertises, and connections. But if you are going to hire people to do this, you are going to hire talents that are locked in one phase and not can have accessibility or capacity for all the other phases. But an international advisory board looking to a company from the outside in can change these talents as they need it, as you need it. So then it's much flexible, much faster, and much cheaper in very, very simple terms. So, as I mentioned, you swap expertise as the capital problem evolves rather than hiring permanently for a temporary need. And then what you do with that talent, it fades because actually you cannot justify that talent anymore, so you have to let it go. Or the same person and say, well, I have no more challenges here, probably look into other organization. And then you say, oh, people are leaving this because the hire probably was not the right one. Anyway, so what do you gain working with me? It's 3 things: outcomes, differentiators, and risk reductions. In terms of outcomes, you get a board level capital architecture that shows headroom, timing, use of proceeds, risk triggers, and alternatives. So the next capital conversation starts from the preparation rather than the pressure. And this is very important. The better prepared you are, the less pressure you have when you are raising. In terms of differentiator, I build that with that international advisory board, bringing in the right capital, governance, and operating expertise faster than with a single executive hire and without the weight of a traditional consulting program. And in terms of risk reduction, back to the UK, I'm going to give you a public example. And this is a lot of technical lingo, if you may, but I'm going to explain what it means in a second. So a publicly listed company I'm following on the London Stock Exchange in the 2026 preliminary results to this year stated that the undrawn committed bank facilities and available cash resources supported the directors' conclusions that there were no material uncertainties regarding going concern. That is what proactive capital architecture looks like in public. Now, what that means? What it means in a basic terms is that the company had enough cash in bank plus extra borrowing it had already agreed with banks but had not used yet. Because of that, the directors felt confident that the business could keep operating normally and was not an immediate financial trouble. Absolutely fantastic position to be, and this is in public display now in the minutes. So this is an ideal position, and I wanted to bring it to you because this is what the public listed companies are doing and showing how they do it. Literally, they explain what they do it. Now, can you do that in your own organization? Of course you can do it. And it's not that expensive and it's not that difficult. It means that you need the right advisory team in place helping you to get this done. So one action you can take home today, and it's doable in 30 minutes or less, ask your CFO or your accountant for a one-page, 18 months capital map showing current facilities, expire dates, convenient triggers, and likely cash pinch point, and 3 funding options before they become urgent, right? And start to pitch around about this, because this is where exactly this company said they have enough working capital, they have enough cash in bank to keep operating, but also they have facilities that are ready to or available to them and ready for them when they need them. So let's pause it here for today and reconvene tomorrow, because if you remember, yesterday I mentioned board proof, today capital architecture, and tomorrow I will wrap the week by showing how the latest UK governance changes turn transferability from a nice idea into a live diligence issue. Now, if you're a founder-led leadership team or investor-backed executive or a group or a non-executive team, and you want help strengthening fundability or getting funds through an international advisory board, as I explained today, set up a 30-minute call so I can understand your position and how an independent international advisory board looking from the outside in your organization can help you and your team without stepping on your toes, without the traditional consulting overhead, and without the public theater. So have a great day, and I'll see you tomorrow. Thank you, and bye-bye.